The interest rate that you should select is not quite as simple as selecting whatever the lowest interest rate is that's available. So I'm going to walk you through a little bit about what formulates interest rates and how you can go about deciding which interest rate you should actually take and what it's going to end up costing you in the end. Make sure that you tune in to the episode before this one. So that one is laying the foundation for what you are going to be hearing throughout this episode. So if you're not familiar with what discount points are and how they're formulated and what discount points mean and everything, go back and listen to the episode from last week, because that's going to lay the foundation for everything with discount points and interest rates before you jump into this episode. So to start off with how interest rates are formed, interest rates are dictated by the bigger economic market. In particular, the 10-year treasury yield is what most interest rates when it comes to mortgages tend to follow. So when the 10-year treasury yield goes up, interest rates tend to go up. When the 10-year treasury yield drops, interest rates also tend to drop. Now, this is not a one for one because there is a gap between the two. And this is going to get a little bit technical, so I'm trying to keep it at least at a broad level so that I don't lose any of you in this podcast. But this is really good information that you need to know to help formulate and help you decide whether or not you should take one interest rate over another, and whether or not you should be going with the lender that's just throwing the lowest rate at you. So again, interest rates follow the 10-year treasury yield, and that is what is causing interest rates, for the most part, with most mortgages, to go either up or down. Now, when you have rates that are changing every single day, what's changing so much is not exactly the rate itself. Now, sometimes the actual rate does change, but what is changing more often than the rate is the price for that rate. So for example, let's say that there is an interest rate sheet that a lender has, and that rate sheet, let's just say, goes from 8% at the high end all the way to, let's just say, 5% at the low end. So you can have an interest rate between 8% and 5%. Now, there are going to be different prices for all of those interest rates. So let's just say Monday through Friday, all of the interest rates that that lender can offer you might be 8% to 5%. However, that 8% on Monday might cost you nothing. But on Tuesday, maybe the market changes and that 8% rate costs you $200 to get now. But on Wednesday, the market goes in the opposite direction, and maybe now you get $100 credit for taking that 8% interest rate. These are some of the things that I'm talking about when I say that it's not so much the rate itself that changes on a day-to-day basis, but the pricing for that rate that changes on a day-to-day basis more frequently than the actual rate itself. Now, you can have rates themselves that actually change. Maybe on Monday, that rate sheet goes from 8% all the way to 5%, but maybe on Wednesday or Thursday, now it's 7.75%. And it goes down to, 5%, or maybe it goes up to 8.25% and it goes down to 5.5% or 5.75%. What that can change as well. But what's changing more often than the actual rate itself is the price that you pay for that rate. And that's the actual cost that you're going to see when you close on that home that you're looking to purchase, is the actual price that you pay, because that's what's going to have to be paid up front. So in getting into, should you get a lower interest rate? It depends. And that's going to be the answer for so many things, but I'm going to give you the tools so you can navigate better what is going to depend on, so you know whether or not you should take that lower interest rate, or whether or not you should take the higher interest rate and look to refinance into a lower rate later. So let's say that you are looking to purchase a home and the seller is offering to give you $10,000 toward closing costs. Well, if the seller's going to offer to give you $10,000 toward closing costs, there's a lot of things you can do with that $10,000. It doesn't have to go toward closing costs. You could also take a price reduction. So for example, the seller is going to net the same if they're willing to give up $10,000 of what they would have received in profits to help you close on this home. So you can put that $10,000 toward a price reduction. Let's say that you're purchasing a $300,000 home. You could say, hey, instead of putting it toward closing costs, just sell me the home for $290,000. And you can take care of all the closing costs yourself as the home buyer and just take that $10,000. Instead of putting that toward closing costs, you can put it toward a price reduction. What that does for you is it will lower your monthly payment a little bit, because if the seller puts all that money toward closing costs do not affect your monthly payment. But if the seller, instead of putting that toward closing costs, says, I'll give you the house for $10,000 less, well, now you have a home that you're paying less money for, which means your monthly mortgage payment is going to be slightly less than what it would be if you were paying the full $300,000 for that home. Now, another thing that the seller can do is that seller can put that money toward buying down your interest rate. Now, if that seller were to put that money toward buying down the interest rate, this is where you're going to see the biggest impact on your monthly payment. Let's take that $10,000, for example. If, let's say, the rate that you can get is let's say a 7% interest rate, and you want to buy it down to a 6% interest rate. But let's say the cost to buy it down to that 6% interest rate is going to be $8,000. So if the seller is willing to give you $10,000, you can put $8,000 of that toward buying down your interest rate from a 7% to a 6% interest rate. Now, I know, like I said, it's getting into a lot of numbers, but stick with me for a minute. Now, let's say that the difference in your monthly payment to go from that 7% interest rate to a 6% interest rate is $200. We'll keep it an even 200 to make the math a little more simple. So $8,000, you can go from a 7% interest rate to a 6% interest rate. And the cost or the savings that you will see on that will be $200 a month. So this is kind of how you determine whether or not it's a good deal for you to take that interest rate or whether you should leave it on the table. So if it's going to cost you $8,000, but it's going to save you $200 a month, you want to know how many months do you need to stay in this loan before it makes sense for you to take that interest rate. So if you take the 8,000 divided by that 200, you get 40 or 40 months. So 40 months divided by 12 gives you 3 1/3 or 3.33333 repeating. So that means it's going to take about 3 years and 4 months for you to get to that point to where now it made sense for you to buy down your interest rate. However, that's not all of what you have to determine to see if whether or not it made sense. So you also have to look at what's going on in the market at that time, because let's say, for example, that interest rates in the market are going to be going down. And let's say that next year interest rates drop from 7% to 5.5%, or in 2 years they drop from 7% to 5.5%. Now, if you paid $8,000 up front, and that $8,000 is going to take 3 1/3 or 3 years and 4 months for you to break even, well, then now, if you were to refinance, mean get a new mortgage anytime before 3 years and 4 months, you're losing money. So in that instance, if rates dropped in a year or two, you could have refinanced into, let's say, a 5% interest rate or 5.5% interest rate and been better off than rather than having bought your rate down to a 6%. And now for it to make sense, you got to stay in that rate for 3.5. You can still refinance, but it's just going to be, you're losing money at that point because you've already paid $8,000 up front to get the 6%. So now if you don't stay in that loan for at least 3 years and 4 months, it's not going to make sense for you to have paid that $8,000 up front that you paid in order to get that rate. So again, we'll take this back from the top again for anyone that I may have lost on this. So again, rates come at a price. Every rate has a price attached to it. Now, there are some rates that are what are considered par, meaning that there's no price attached to it. But then there are other rates, which generally, the lower you go down the rates, the more you're going to have to pay to get those lower rates. So again, rates come at a price. So start taking it from the top. You have a 7% interest rate, but you want a 6%. It's going to cost you $8,000 to buy your interest rate down from a 7% rate to a 6% rate. So you pay the $8,000 up front. Now that you have a 6% rate, that 6% rate will save you $200 a month on your monthly mortgage payment. So whereas your monthly mortgage payment would have been one amount with a 7% interest rate, now it's $200 less now that you paid $8,000 and got a 6% interest rate. However, to find out how many months that $200 a month savings is going to take to equal $8,000, you take that 8,000, you divide it by the 200, and you get 40. It's going to take you 40 months of saving $200 a month in order for $200 a month to add up to $8,000. So that means you're going to 40 divided by 12, because there are 12 months in a year. 40 divided by 12 is 3 years and 4 months. So you would need to keep your mortgage for 3 years and 4 months in order for it to make sense for you to have paid $8,000 up front to get a 6% interest rate. That's how it works. And so is that a good deal? That's what a lot of you might be having the question of. Is that a good deal? Should I do that? It depends. Again, everything depends. If rates are currently low and you buy your interest rate down to a low level to where, hey, maybe we don't get back to those interest rates, or maybe we're not going to get too much below that, then it might be worth it. Or you might, if rates are high, maybe it's not worth it. Maybe we're in a market where a lot of financial analysts are thinking mortgage rates might drop in the next year and a half or 2 years. So it might not be worth it. I mean, no one can predict the future, but it might not be worth it for you to take that, to pay $8,000 up front to take a lower interest rate if rates are going to be dropping next year or the year after that, because you can take a 7% now. And even though you're going to pay $200 a month extra on your mortgage, if you refinance in a year, that means that's 12 months that you had to pay $200 a month. So that $200 a month times 12 months, that's the $2,400 that you would have had to pay more on your mortgage. So $2,400, but you didn't have to pay $8,000 up front. So essentially you saved, what's that, $5,600. So with that $5,600, you could now take that money, and if interest rates were to drop in a year, you could take that $5,600 that you saved, and now you can permanently refinance your home and get a lower interest rate. Let's say rates drop to 5.5. Instead of having paid $8,000 to get a 6% interest rate, you kept the 7% for a year. It cost you $2,400 more to keep that 7% interest rate for a year, because you, again, paid that $200 that you would have saved on the 6%. So it cost you $2,400 more to keep it. However, you save $5,600. You refinance with the $5,600, and if interest rates go down to, let's say, a 5.5%, now you get a 5.5% rate for the remainder of your mortgage, and for that same $8,000, rather than, and I'm not saying it's going to cost you $5,600 to refinance. I'm just using these numbers as an example. But now, for the purposes of this example, for that same amount, you were able to get a 5.5% interest rate instead of a 6% interest rate by taking that higher interest rate earlier and refinancing into the lower interest rate later. So again, hopefully this is not losing you too much, but this is really the key stuff that you want to get and know and understand when you're determining whether or not you should take a lower rate or a higher rate, because a lot of people pay a lot of money up front, not understanding what it is that they're actually doing and how they could better navigate being put in a better financial situation by having the knowledge on knowing, maybe I take the lower rate instead of taking the higher rate. And so by doing that, maybe they put themselves in a better financial situation rather than just always taking the lower rate. Because I know a lot of people who don't understand, again, they'll take the lower rate, pay all of these discount points to take the lower rate. And when interest rates drop in a year or in 2 years, they're like, okay, now I'm going to refinance. It's like, well, you should have never bought the rate down then, because now you're just losing money if you're not going to keep that rate. So there are some situations in which you can hold on to the interest rate that or excuse me, where you can buy down your interest rate regardless of what might be happening in the economy. One of those instances is if the seller is paying for it. This is an instance in which the money is not coming out of your pocket. So it's more pleasing, it's more of an acceptable thing for you to go ahead and get that lower interest rate because the seller is paying for it. Again, if you have a seller that's willing to put out $10,000 or $15,000 to help you close on this home that you're purchasing, well, if you want to put all that money towards paying off your interest rate, let's say you have the money for closing cost and down payment and everything, and you want to put all that money towards buying down your interest rate, well, then it's the seller's money. You can use all that money to buy your interest rate down as low as you can get it. And that's going to really help out how much you're paying every month on your monthly payment. So that's one situation in which, yeah, it can be worth it for you to buy down your interest rate. The seller's going to pay for it. One situation in which it might not be worth it for you to buy down that interest rate is if rates are predicted or at least projected based on what's going on in the economy to go down, then you might want to hold off on buying down that interest rate because sometimes buying down your interest rate will be very expensive. So what I mean by that is you could have let's say you could have a 7% interest rate, but it might cost you $8,000 to buy it down to that 6% interest rate. That's a sizable amount of money to buy your interest rate down from a 7% to a 6% to save $200, which is not going to pay for itself within the next 3 years. It's going to take 3 years and 4 months. And another thing I'll throw in there, when you are buying down interest rates, in my personal opinion, the cost that it's costing you to buy it down, you want to have that break even point or that point at which what you're saving equals what you paid up front. You kind of want that to be closer to the 2-year mark, but 3 is like the absolute max, in my opinion, that you want to have that go before, you hit that break even point. In my opinion, you don't want to go above that 3 years for it to break even. If it's costing more than that, then just take the higher rate. But going back to our example, if it's going to cost you $8,000 to buy that rate down 1%, then you might not want to go ahead and buy that rate down, especially if it's going to cost you $8,000 to do it, and the seller's not going to pay for that because you're going to pay $8,000 up front, and maybe the market shifts or the market changes. And again, like I said, the rates and the cost of the buy downs also can change. So we might be in a market where the cost to buy down that rate from a 7% to a 6% is $8,000. However, that can change in a year or however long, and it can go to the point to where maybe the cost to buy it from a 7% to a 6% rate shifts to $4,000. So now instead of it taking 40 months for you to break even, now it takes 20 months for you to break even. So you went from 3 years and 4 months to now less than 2 years to be able to get to that break even point. And that is something that you might want to consider, especially if you're going to be staying in this house for any length of time beyond 3 years or 4 years, because you buy your rate down and you don't plan on refinancing and you get it to a rate that's actually a really good rate. Well, now it makes sense for you to pay that $4,000 to buy it down. And in 20 months or in just under 2 years, you're going to have that pay for itself. And so anything after that 20 months is just icing on the cake. You're just saving $200 a month after that because you've already passed that 20-month point. These are some of the things you want to, consider when you're looking at whether or not I should buy my rate down or whether I should keep the rate that I have. Is a couple of things. One, how much is it going to cost me to buy down this interest rate? Is it going to cost me $8,000? And if so, how low is it going to go? Is it just going down 1 discount point or 1%? Is it going down 1.5% for $8,000? How low is that rate going? Or you also want to consider, so that's the cost. 1, how much is it going to cost? 2, how much is it going to save you on your monthly mortgage payment? Because that can vary as well. Going from a 7% rate to a 6% rate on a $500,000 home is going to have a bigger impact than going from a 7% to a 6% rate on a $200,000 home. And so you want to know, how much is it going to save you as well? How much is it going to cost? How much is it going to save me every month on my mortgage payment? Because that will also determine whether or not you want to do that buy down and get that lower rate. How long is it going to take me to break even for the amount of money that I'm saving to equal the amount of money that I'm having to pay up front to get this lower rate? That's the third thing. So how much is it going to cost? How much is it going to save me on my monthly payment? How long is it going to take me to break even for that, again, money that you're saving every month on your monthly payment to equal the amount of money that you're paying up front to get that lower rate? And the fourth thing that I will put in there as well is, what is going on in the economy right now? What are the predictions for the future? This is the wild card, because again, no one has the crystal ball that can tell exactly what's going to happen with interest rates in the future. However, it is important to know, are rates predicted to go higher? Are rates predicted to go lower? Is the economy improving and getting better? Or is the economy kind of looking like we're going to move into a recession, in which case sometimes, a lot of times, interest rates tend to drop when we get into recessions. There's a lot of things to consider, but these are the things that you want to consider to determine whether or not you want to buy down that interest rate or get that lower interest rate. And again, when you're shopping lenders, these are the things that you want to consider when you're shopping lenders. This is not what most people think about, but these are the things that you should be thinking about, because these are the important things that are going to help determine how much money you're going to save and whether or not you're getting put on the right track to put you in the best position financially. And that's why I try and do my best to educate people, giving them the tools that they need to be able to make smart, informed decisions. Because a lot of people, again, will take the lender that, oh, this lender can give me a 5% interest rate. You're giving me a 6% interest rate. I'm gonna go with the lender that can get me the 5. Go back and listen to the previous video that I did last week, the previous podcast episode, because I explained in that one how that lower interest rate might actually cost you more than the higher interest rate. So, but a lot of people don't know that. A lot of people aren't aware of how it's costing you more. And so because of that, people just take the lower rate. They pay more money, and it puts them in a worse position financially than what it would have, because they're only looking at, oh, I get a lower rate, so I have a lower monthly payment. But you're paying more up front. And then when you refinance that rate, now you're losing money on that money that you paid up front to get the lower rate in the first place. These are the things that you need to be having that conversation about or thinking about when you're shopping through lenders. So to go through those 4 things again, how much is it going to cost me to buy down my interest rate? Is it going to cost the $8,000? Is it going to cost the $4,000? Is it $3,000? How much is it going to cost me to buy it down? How much am I saving every month? That's number 2. 1, how much is it going to cost? 2, how much am I saving every month on my monthly mortgage payment? 3, how long is it going to take me to break even? How long is it going to take for the savings that I'm saving every month to equal the amount of money that I had to pay up front for that buy down? And 4, what's going on in the economy right now? What's happening in the market that could influence interest rates to go up or influence them to go down? Because that will also play into your decision as to whether or not you should refinance now. If rates are high now, but rates are predicted to go down, but right now it's going to be expensive for you to buy that rate down. Maybe it cost you that $8,000 to just go down 1%. Maybe you just take the higher rate, even though rates are high right now. You take the higher rate, because by taking the higher rate and not paying that, a lot of money, $8,000 to buy that interest rate down, you wait a year, wait 2 years as that interest rate start to go down. Now you spend much less money to get a lower rate than what you would have gotten if you had bought it down earlier or sooner. So these are the things that you should be considering, and the factors that are determining whether or not it's a good idea for you to buy down your interest rate or to even take a lower interest rate from a lender who's offering you a lower interest rate. Ask them about the discount points. If you don't know what I'm talking about, watch the previous episode. Ask them about the discount points because that is really going to be key in how much you are paying for these interest rates up front. So again, that's what I have for you. Subscribe to the channels, hit the subscribe button. It's literally going to take like 2 seconds for you to just hit the subscribe button, and make sure that you stay tuned in because every week I'm pushing out more and more videos to try and help you be more educated in making those decisions that are going to put you in a better position financially. That's all I have for you. Thank you for taking the time to tune in. Take care. Be blessed.